Okay, so today we're diving into, what is arguably the biggest currency event for India in years.
This huge one.
We're talking about the Indian rupee on December 3rd, 2025, decisively breaching that massive psychological barrier, 90 to the dollar.
And it didn't just breach it, it hit a record intraday low of 90.30.
Which now makes it one of Asia's weakest performers. Down, over 5% for the year?
That's right. And our job today is really to unpack how we got here and, maybe more importantly, analyze the huge calculated gamble the central bank seems to be making.
Right. So where do we start? What's the main driver here?
Well, what's so fascinating is that it's not just one single thing. It's more like a potent cocktail of pressures all hitting at once.
A perfect storm.
Exactly. And the most immediate ingredient in that cocktail is just a massive capital exodus. The foreign institutional investors, the FIIs.
I saw those numbers. They're staggering.
They are. We're talking nearly $17 billion in net selling of stocks just this year. That puts India right up there with the worst hit emerging markets globally.
So you have all this money flying out. And then on top of that, you have the more the structural problem, right? The trade deficit.
Yes, that constant chronic demand for dollars for, the essentials.
Crude oil, gold, electronics, the big ticket items.
The pressure from that alone is immense. And then you throw in the geopolitical situation.
The U.S. trade deal uncertainty.
That's a big one. The lack of clarity there, plus those steep U.S. tariffs, some are up to 50%. It just blunts our ability to earn the very dollars we need to stabilize the currency.
Okay, but wait. The government's official line is pretty relaxed.
That's the paradox, isn't it?
The chief economic advisor, V. Anantha Nazawaran, basically said they are not losing sleep over this.
Right, which sounds a little strange when $17 billion is heading for the exits.
Exactly. So is the Reserve Bank of India's, muted intervention just them being negligent? Why would you let the rupee break the 90 barrier?
I don't think it's negligence. It looks much more like a strategic choice, a calculated risk.
A strategic choice to let it fall. Why?
The key, I think, is a kind of technical number. The rupee's real effective exchange rate, or RER.
Okay, you're gonna have to translate that for us.
All you need to know is that it has fallen below 98. And that number is basically a signal to the RBI that the rupee is, believe it or not, fundamentally undervalued.
So they're thinking a weaker rupee is actually a good thing.
In the long run, yes. They seem to be accepting this short-term volatility to make India's exports more competitive. It is a very deliberate gamble.
But that gamble has an immediate downside. Analysts are already warning that if we stay above 90, we could see a speculative run toward 91 pretty quickly.
And that brings us to the real-world consequences, the immediate ones.
Let's talk about that. Imported inflation has to be number one on the list.
It has to be. Think about it. India imports something like 90% of its crude oil.
And over 60% of our edible oils.
Exactly. These are things people have to buy. When the rupee gets weaker, the cost of all that stuff just goes up. Instantly, it hits everyone's wallet.
So that's the big macro threat. But let's bring it down to the individual level, the kitchen table. What does this currency shock do to a middle-class family with, say, foreign debt?
This is where the pain is most acute, the liquidity shock. Specifically, look at families with dollar-denominated foreign education loans.
Right. A lot of those out there.
So imagine you have a $50,000 tuition bill. When the exchange rate was 80 rupees to the dollar, that's one cost. Now at 90, that same tuition bill has just jumped by 5 lakh rupees.
Wow. That's a 12 or 13% hike practically overnight.
And it forces families to just pull back on their other spending to cover it. Now, on the flip side, some sectors are winning.
IT firms, I assume. They bill in dollars.
They're the clearest winners, billing in dollars, paying salaries in rupees. But for manufacturing and pharma, it's a much more mixed bag because they rely on imported materials, and those U.S. tariffs are still limiting their export gains.
So bringing this all together, the RBI has its big monetary policy committee meeting coming up. The stakes now feel incredibly high.
They've never been higher.
And this is the final thought we want to leave you with. If the RBI's strategy, this tolerance for a weaker rupee, starts to really push up that imported inflation we just talked about,
A very real possibility.
will the central bank be forced to make a terrible choice? Will they have to sacrifice the domestic growth we were all counting on by postponing rate cuts or even hiking rates just to defend the currency and stop the capital flight?
That's the real trade-off, isn't it?
That is the ultimate trade-off that this breach of $91 has just laid bare for everyone to see.